Hello friends, last week in my video we discussed how the market indicated whether it was hoping for continuity in the political policy or the data was suggesting some kind of uncertainty, some kind of caution. And in this week's video also, I want to take this forward and share with you the 5 factors or 5 data points that will basically tell you by Monday evening as to what will happen on Tuesday once the vote counting is started and numbers start trickling in. Do note before you form hard opinions here, market data, the numbers that I'm crunching are based on what the traders are doing. Now, what traders are doing can be based on hope. They may not be completely rational. There might be mental prejudices. There might be expectations. There might be personal biases. So that data is basically like to be slightly colored. But it also remains a fact that at least what we are following is what people are doing rather than what they are saying, because in stock markets it is said talk is cheap, follow the numbers. So we are going to follow the numbers and we are only going to look at data, not at any other factor. I am not a trained psephologist or an election analyst, and even after all this number crunching, elections are known to spring surprises. So friends, I request you to stick with me till the end of this video, because I'll keep discussing various aspects. I've added a couple of studies in this video which you need to monitor. So without much ado, let's jump into what we do every week and start with the weekly market roundup window. As you can see on your screen, the late rally that was basically powered by banking and financial sector stocks, which is what the bank Nifty gained 0.03%. Now, I have told you that nothing happens in financial markets without a reason, and the reason itself is always financial. Banking and financial sector stocks have a weightage of almost 34% in the Nifty 50. So you push up banking and finance and the Nifty automatically gets cushioned. The next two heaviest weighted indices put together do not even combine to make 34%, as I have indicated in the weightages chart. So there you have it. This is basically a concerted effort to boost the Nifty, and the bank Nifty basically cushioned the markets. The broader base Nifty 50, of course, fell 1.86%. The US dollar index eased somewhat last week, and that basically cushioned emerging markets, including India. Gold and silver went up on the basis of a weak dollar, whereas natural gas went up due to expiry of the May series and commencement of the June series. Crude oil was down along expected lines. Do remember, 2nd of June is the OPEC meeting. It's a virtual online meeting, and we'll basically have these data points factored into prices only on Monday. Now, the Indian currency, the rupee, basically eased against the dollar, because the dollar versus the rupee was at 83.51 compared to 83.13 last week. The NSE lost almost 2% in market capitalization, which tells you that profit taking was broad-based. MWPL came down along expected lines because it was an expiry week, and all three indices in the US markets were negative, and that basically provided headwinds for domestic markets as well. Friends, take a look at the inset box on your screen. What it tells you is that the bank Nifty has been underperforming the Nifty 50 over a 4-week period all over again. Over a 12-week period, the bank Nifty has relatively outperformed the Nifty 50 at 2.40% return over Nifty's 0.1% return. But over a 20-week period, we are back to underperformance. Now, even this underperformance is actually masking something even more graver. What is it being masked is that these are spot values. If you are a real world trader, and a real world trader's worldview is always different than a non-trader academic market observer, you would instantly realize that as a real world trader, if you were to buy and roll over your long positions, you would pay cost of carry, which means over a 20-week period, both these indices have yielded negative returns for a buy and hold trader. Now, that is something you need to keep in the back of your mind. I'll be recording a special video which will be released very, very soon as to who the market rewards. I'm talking of pure traders, not as investors. So, investors, please reserve your comments till you see that video. And now let's go to our in-house indicators. I start with the MWPL. Now, by and far, this is one of the most critical studies that I share with my online family. It is one of the least understood and underrated studies. Now, these MWPL are positions that are initiated by traders as a component of the total exposure allowed by SEBI. Now, higher MWPL obviously means higher risk appetite, and lower MWPL tells you caution. Now, look at what really happened. Last week, ahead of expiry, we scaled 43.44% MWPL, which was the highest in many, many years. I'm not talking of months and quarters, I'm talking of years. Prior to that, the expiry of, after the expiry of April, we basically saw a low of 31.17 in MWPL, which was sharply higher than the expiry of March. That tells you that traders were building up positions in spite of knowing that elections were coming. So this was a higher bottom at 31.17 and a higher top at 43.44. But after expiry on Thursday of the May series, the MWPL has fallen sharply to 28.55. It is lower than last previous expiry's low as well. Now, traders are suddenly realizing, hey, there are elections and let's be careful out there. So, risk appetite seems to have contracted. This is point number one that you need to keep always in your mind. Now, for the second study, the stock and index futures turnover, these are three concurrent series. So this is June, July and August. Very simply put, traded turnover hit through the roof and went straight up the glass ceiling. We are at a multi-month high where turnover is concerned, which means when the market was falling, there was active participation by futures traders. That means traders were not surprised. They were actually prepared for this kind of fall. Much of the turnover rise also comes from expiry because traders square up their positions in May and reinitiate them in June. But even after you adjust the fact that expiry rollover related double turnover is factored in, the turnover still remains high. Now, for advanced decline ratio, which after the price itself is the best leading indicator, the Nifty has surrendered 1.86% as can be seen from the red line, but the advanced decline ratio stayed below zero for the second week in a row. At 0.58, it has reached the lowest in 20 weeks, that is 5 months. Which means for every 100 losers, there were only 58 gainers. One Marshmallow traders are clearly not bullish. It's the two Marshmallow traders which are holding the fort. Now, what is the difference between one Marshmallow and two Marshmallow traders? That is explained in a special video, which I will be putting up the link in the comment segment and in the description below this video itself. So you can go through it and understand the Marshmallow theory. Now, friends, I come to the basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Just like the options premium, basis also contracts as expiry comes closer. So the basis is telling you that risk appetite after expiry is very high in both the indices. At least as far as the Nifty is concerned, the Nifty has scaled a 20-week period high on the basis, That tells you that people were willing to pay a higher premium to go long. The Bank Nifty, of course, is very close to its period high, but not quite there. The fact remains that optimism is pretty high in two Marshmallow traders. I just told you the one Marshmallow traders are not very gung ho, the two Marshmallow traders are actually gung ho. Now for the impetus. Now, here is a slight paradox. The Bank Nifty, which gained yesterday, last week rather, went up on higher impetus, and the Nifty saw poor impetus. That means that the sell off in the Nifty 50 was not accompanied by very forceful selling. This was more of position unwinding. So that tells me that bulls were actually surrendering their positions rather than basically initiating more of fresh shorts. Part of this could be expiry, but do remember it was both the Nifty and the Bank Nifty that were expiring where monthly series are concerned. So you need to be basically noting what's happening. I have said in my Live Mint column, which is India's first and only media column that offers statistical inputs to its readers, that the Nifty and the Bank Nifty are like the two wheels of a bicycle. Both need to go in the same direction. If they go in opposite directions, the bicycle topples. So here what we saw last week was the indices were going in divergent directions. That's not really very good. Even the impetus was diverging. Now this is another factor that I want you to monitor. Where will you monitor this? Hey, don't worry. It's all there on my social media accounts. I update this every day, particularly on my Telegram channel. Do make it a point to join my free Telegram channel. It's one place which contains all the thoughts and all the reports that I put out here without fail. This has the most amount of content here. Now friends, I come to our exclusive in-house indicator, which you won't find anywhere on the internet, the lift weight thrust drag indicator. Although the Nifty has fallen to a multi-month decline where weekly declines are concerned, the LWTD, as indicated by a red line, has jumped to 0.41 from minus 0.08 in the prior week. That tells me that all other things remaining constant, the market is hopeful. Why am I saying hopeful? I'm saying hopeful because election results are not out yet. The actual trend will get determined from Wednesday onwards. So as we head into the elections, as all things remain constant, it appears that lower levels are going to get buying support from these stronger hands, from the two Marshmallow hands out here. Friends, our in-house indicators done. I now come to the bond market, which I have been leading and basically ahead of the curve in monitoring on your behalf. As far as the Indian benchmark bond yield is concerned, it fell by 1 basis point on a weekly basis, which means bond prices were higher, and that provided a mark-to-market profit for the banks who are the biggest investors in bonds, which is why the Bank Nifty outperformed the Nifty 50 in relative terms. Now, why should you watch bond markets? Because this market funds the asset prices in all other areas in financial markets. This is a fountainhead of money supply. So as of now, the bond market seems to be quite chilled out. The bond market's done. I now come to the Bank Nifty. And as you can see on the daily chart on your screen, the Bank Nifty has rallied on 3 out of 5 trading sessions. The index has gained 0.03% on a week-on-week basis. And the inverted hammer on Monday itself, when the market opened for the week, at a high of 49,689, basically wasn't overcome all week. This high needs to be surpassed if at all the bulls are to get back in the driver's seat, and that too on a sustained closing basis. The price is above its monthly moving average, so the short-term outlook is positive for now. Going to the weekly chart, we see that the price is in a bullish wedge. It's above its medium-term moving average, So the medium term outlook still remains optimistic for a buy and hold investor, but it has formed a prominent long leg doji. Now, a long leg doji is when the open and close is in somewhat in the center of the range, and it indicates indecision and hesitation. Couple that with the low buying conviction shown by the advanced decline ratio in the in-house indicators that we just discussed recently, and you know what we are talking about. Do note that the banking and financial sector stocks have 34% weightage in the Nifty 50, so they are a swing sector. Now, the weekly low at 48,314 levels must be protected by the bulls if the upward momentum is to sustain. Sure enough, on an intraday basis, there might be a breach of this level because election results will be announced on the 4th, but the closing at least should be above 48,314 level. The basis of the bank nifty is extremely high, so optimism is basically at this point in time, along with the risk appetite, fairly robust. Friends, in the week before last, this index was at number 4 in the most volatile counters list based on statistical beta ranking that I maintain in-house. It rose by one notch to number 3, which means volatility actually went up. That means challenge for the retail investor just went down. Now, last week I advocated a range between 50,400 on the upside and 47,550 on the downside, which held perfectly well. In the coming week, I estimate a range between 50,400 on the upside and 47,575 on the downside. Please also watch our daily, weekly and monthly pivots on our free Telegram channel. It will help you laser precise your trades even further. Friends, the bank nifty done. I now come to the Nifty 50, which registered 1.86% losses on a week-on-week basis. And as the daily chart on your screen shows you, this index actually fell on all 5 trading sessions last week. The price is below its month-long moving average, which itself is meandering sideways. Therefore, the short-term outlook appears cautious for now. The 22,800 level, which I have been talking about in the last few weeks, which needed to be sustained on the upside, could not hold, and the bullish momentum faltered. The fall was stemmed by banking, which has a weightage of 34% in the Nifty 50. So, had it not been for the bank nifty, Nifty's fall would have been even bigger. Take a look at the weekly chart on your screen, and that tells you that there was a bearish piercing pattern after a new high was tested in the week itself. Now, bearish piercing pattern is when a bearish candle of the recent week pierces a previous bullish candle more than 50% of the body size. That tells you that the bulls have been wounded but not killed. A piercing pattern is not as powerful as an engulfing pattern. So we still have some hope left if after Wednesday's announcement, or if after Tuesday's announcement of results, if markets are to take out the high which the Nifty made at 23,111 levels, the bulls can definitely return back to the driver's seat. So as far as the Nifty is concerned, it is indicating that the election results is still open and up for grabs. The price is still above its medium-term moving average, so the medium-term outlook for delivery-based investors is still okay. The week's low of 22,417 must be defended by the bulls if the momentum is to sustain, and below it is the 22,100 level, which is the medium-term moving average reading, which is the final threshold if the upward momentum is to sustain. I don't want a breach of 22,100 on a sustained closing basis, which would basically make me rethink the outlook for near-term bulls. Now, the problem is that these bulls have recently paid mark-to-market losses because the index has fallen on all 5 trading sessions, and they've also paid rollover charges for rolling over their long positions from the May to the June series. So if at all the price is to slide below 22,100, they're going to get very, very sweaty under the collar. So on the flip side, like I mentioned, 23,111 is a level that must be overcome. Do keep your tail risk hedges in place because the markets are going to be very, very volatile, and the hacienda or the tail risk hedges can actually be lifesavers. Friends, in the week before last, this index was at number 10 on our statistical beta rankings that we maintain in-house. It rose 2 notches to number 8, which means the challenge levels for a retail trader went up here as well. Last week, I advocated a range between 23,500 on the upside and 22,425 on the downside. Admittedly, the low was breached, but it was breached only by 8 points because the low was at 22,417. Now, this is all thanks to the statistical trading model IBEX that we use in-house, that we get precise estimates of the markets. In the coming week, I estimate a range between 23,075 on the upside and 22,000 on the downside. In addition to these ranges, which might be violated due to extreme price volatility, do monitor our daily, weekly, and monthly pivot levels because they will help you get more precision into your trades. Friends, I now come to the last bit of statistical analysis wherein I gauge a trader's risk appetite as indicated by the 4 segments in the FNO, futures and options space. The index futures turnover contribution went up by 15 basis points. The stock futures turnover contribution went up by 48 basis points. Index options turnover contribution fell by 13 basis points and stock options turnover contribution fell by 50 basis points. Now, what does this indicate? Friends, futures require a lot more money in terms of span margin, in terms of mark-to-market margin. They are a lot more volatile as compared to options. The fact remains that if traders are playing more in futures, they are basically showing more signs of aggression. Now, aggression does not necessarily mean conviction. Aggression is aggression. It could be hope, it could be conviction, it could be part of both. So the fact remains that some of this turnover contribution going up is also because of expiry. Like I mentioned, you square up in May and you reinitiate the position in June. So turnover recorded is dual. But hey, that goes for options as well. So why aren't options being rolled over as much? The fact remains that even after the rollover theory, aggression levels were high. So is hope. Now, hope is something that one marshmallow trader's nurse. 2 marshmallow traders are extremely savvy. So do monitor the marshmallow theory video as well. Now, friends, I come to my strategy before I go to what are the 5 indicators and data points that you need to watch to know whether Modi 3.0 is a reality. Friends, I will prefer to wait and watch on Monday because the election results are likely to be out on Tuesday. And Tuesday's trading will depend on what the vote count during market hours is like. If at all a clear verdict is out before 3:30, markets will see their minds being made up in either direction. I feel the markets are hoping for a clear mandate and they are extremely nervous about a prospect of a hung parliament. Now, if at all there is no hung parliament verdict in the market, I think all is well. There would be directional moves in either direction. That is what a trader wants. We want the price to go in either direction so we can put food on the table for our family. Right? We don't want a confused and a directionless market, which would happen only if there is no clear verdict. Tail risk hedges are something that are a must and I will keep them in place. Now, here is a list of high MWPL stocks which I promised you on my social media accounts I will share. This is a weekly compression chart. I had earlier shared a daily compression chart for short-term traders. Now this is a kind of a big picture move. Look at what's happening over the last 20 and the last 10 weeks. This list basically goes beyond or transcends beyond expiries because in the last 20 and 10 weeks, expiries have come and gone. If at all MWPL is still risen in spite of expiries, that means traders are nursing the maximum amount of hope, and not just hope, they also have initiated positions in these counters. So if at all there's continuity in the market and markets feel, hey, we got the government that we were hoping for, these stocks might just see some more run up. On the other hand, if there is any negative surprise, then these are the counters where maximum positions are being held, and these positions might just witness hectic unwinding, which is why volatility on counters where MWPL has risen the most will be the highest. These are vulnerable counters. Now, I would want my online family to benefit from our data-based approach without any bias. We have no affiliation to any political party or biases to and against any party. We just want to make honest trading profits backed by data. Now, this is a list that I will update for you on my Telegram channel, which you must connect with me. It's a free channel, you pay nothing. Here are my contact coordinates. Do connect with me on my Telegram channel on Monday and Tuesday evening post market. I will be updating the daily and the weekly MWPL highest position list for you so that you can take advantage of this data point. All rational and savvy traders must keep a constant eye on MWPL to know which way the smart money is going. We don't want smart money to be talking in direction A and trading in direction Z. Let's follow the money trail. The talk, like I said, is always cheap. Depending on your feedback about these new studies that I'm putting up on my YouTube channel, I could share a lot more cutting edge studies which are low key, not discussed too much in the public domain, but yet are extremely accurate, and they are used by all the biggest and the most profitable hedge funds in the world. So do let me know in the comment segment as to how much you want me to go in greater detail about these statistical trading models that we build in-house, and of course behavioral trading models that we build in-house. In the week ahead, I will keep a particular focus on public sector units. Out of public sector units, oil marketing companies, banks, energy and power companies would have a particular attention. I'm not talking about bullish attention. I'm, as a trader, looking out for two-way directional trades, because as a trader we just want big percentage moves so as to capture some trading profits. Now, the one particular thing that I noticed was that the MWPL data is surprisingly not showing too many PSU stocks being the biggest gainers in MWPL, with the possible exception of Hindustan Aeronautics, which appears over a 20, 10 and 5-week period. I have not seen too many public sector units coming in MWPL gainers. Now, this is something that's a very interesting finding. Now, this is something that we must discuss at a later date. It will require another YouTube video by itself. In the energy and base metals commodities space, I maintain my view that a super cycle is an erroneous assumption. Even as the price shows a regular bull market, that is because of the debauching of the fiat currency and the buying power of the currency going down, but super cycles are a no-no. That means metal mining company stocks may just get a lot more volatile in the week ahead. Bullion is witnessing the much anticipated correction and consolidation. This is something that I had warned you both in my video and in my live mint column because of the run up that we've seen there. But the broader picture still remains positive, and lower levels will attract strong hands coming in and supporting the prices. I continue to seek theta decay opportunities in oil and gas and have a bearish view for the long term. The OPEC meeting on 2nd of June may impact the price in the absolute near term, but in the long run, I do foresee higher levels witnessing supply from sellers and prices running into resistance. Now, my Telegram channel has lots and lots of views, research reports, content that I have to share with my online family about oil and gas particularly. It's a passion with me to trade oil and gas in the commodities space. So if you log into my Telegram channel, you'll find a lot of ideas there, actionable trading ideas that you can form from the data that I have presented there. So please, let's connect. Now, friends, for the segment that I promised you, I would record the 5 data points and why you need to watch them. First and foremost is MWPL. Market-wide position limits tell me as to whether people are actually putting money where their mouth is or it's just quack, quack, quack. All right. So if at all MWPL is going up on Monday and Tuesday, that means people are buying in spite of the fact that there are election results in the pipeline. That is number one. Buying must continue. If at all MWPL comes down, that means they are telling you to buy, but they themselves are selling. That would be a big red flag. Now, basis. Basis is a good barometer of risk appetite. If at all people are paying higher and higher premiums to go long, basis should remain either constant or it should rise a little bit. Do note that there is always a time decay in the basis, but if at all you are more risk prone, you're open to the idea of taking bigger risks, the basis should either remain constant or even go up. Why don't you pay a bigger premium? Show me where your money is. Impetus. Impetus is the momentum indicator that we have made in-house. All rallies in individual stocks and indices must be accompanied by higher impetus. If the rally is on poor impetus, that means it is short covering. It is not fresh buying. Now, short covering might push up the price temporarily, but once the short covering is done and over, what happens? Price comes down. So impetus must go up. LWTD, lift, weight, thrust, drag indicator. If the price is going up and the LWTD is also going up, maybe with a slight lag, that's okay. But if at all there's a divergence, remember what I told you about 2 wheels of a bicycle. If one wheel is going this way and the other wheel is going this way, the bicycle falls. So price and LWTD must rise in tandem. And now for the 5th and the final data point to watch, the USD INR. Why is the USD INR so important? Now let me ask you a question. What is the best barometer of any nation's economy? Now if you tell me it's the stock index, I'll tell you you're wrong. Hey, that's wrong. Because every citizen of a country does not invest in stocks. But every citizen of a country has that country's currency in his pocket. And if the currency is becoming stronger, the citizen is getting stronger. So if the rupee is to get stronger along with all the other 4 data points, I would say that the market is in a comfort zone. If at all the rupee starts to weaken and it shows signs of extreme volatility, that would be a first red flag as far as I'm concerned. If the rupee starts flying all over the place, I would basically sit back and not deploy more money. Friends, do let me know in the comment segment as to how you like my work, particularly this video, because a lot of effort has gone into this. And before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And do share the video with your friends and family and smart traders like yourselves to help me reach out to a wider audience. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable and safe trading week ahead. Bye-bye.